All right, so let's get started here, and I'll try to answer these questions as we go along. Again, I'm Dave Wise, and I've been doing this. I've been trading for 14 years, almost 15 years full time, and I have been running this room, the Compass Options Room text alert service, for about 2.5 years, since January of 2022, which was the first month of the bear market that started in 2022. But during that period of time, we've had 31 months now of trades. I have 28 winning months, 3 small losing months, and a really, really good track record, which I'll go over for you. All right. So first thing I have to do, of course, is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself and Redline Trading are licensed financial advisors, so we won't be giving financial advice. All right. So by the way, during this presentation, if you have a question that you need to get a specific answer to that I can't answer, you could just put your name and number, or even if you're just looking for more additional information, you put your name and number or your Skype and username in the chat box or in the question box, and Rory from Rightline will give you a call back and follow up with anything that you need to get answers on. All right, so this is just a graphic of the Compass system. I use a system called the Compass system. I run it on Thinkorswim. It runs on Ninja. Basically, it tracks institutional money flow, which is critical. This is the most important thing that you need to know when you're going to trade. You want to be trading when the institutions are in there, and you don't want to be trading when they're not. All right, and this is kind of just a graphic of what the alert service looks like. It comes up on your phone. SMS alerts comes out usually 15 to 20 seconds after the alert goes out, which is on high probability trade setups, and it looks like that. So we'll talk about that as we get into the presentation a little bit more. All right, the first thing I do want to cover before we get into anything is to talk about what drives the market. It's really important to understand what drives the market so that you can take advantage of market trends if you know they're being driven by institutions. So this is just kind of a graphic representation of traders. Basically, these are retail traders, these small little marbles, and these are the institutions, the big marble. When retail traders such as ourselves are in the market and without institutions, when we're the only ones trading a particular stock or a particular ETF, etc., what you get is you get a lot of chaos and you get chop. And you're not going to make any money when you're just trading against other retail traders if the institutions aren't in the trade. You've got to know when the institutions are in the trade. Now, when the institutions enter the trades, that's when the trends start. That's when trends reverse. This is what you can follow, and this is what we need to find out if they're in there or not in there. And for institutions, just for informational purposes, you probably already know, are made up of investment banks, Goldman Sachs, JP Morgan, Morgan Stanley, all the big investment banks who have trading desks, but most of their trading is done through algos, through computer systems that they call algos, which drive about 80% of the volume in the market now, 80, even probably more than that. But the institutions also consist of hedge funds. Hundreds and hundreds of hedge funds are in the market with billions of dollars. They're also become a part of what would be considered institutional traders, and so are mutual funds. Vanguard, T. Rowe Price, they trade and invest huge amounts of money as well. So they're part of this particular institutional group, and so are huge pension funds, any kind of pension funds for states and local governments, etc. So that's what makes up this and the institutions, and this is what we need to make a determination if they're in a trade or not in a trade, if we're going to take that trade. So that's important to understand. All right, so Eric, you're in Charleston? No kidding. Well, a neighbor. Good to see you here, Eric. We have a couple of rules to trade by in the room, and this also applies to the alert service. We trade the best and skip the rest. It's easy to say, but I'll tell you how we determine that. And the other objective is, our objective is not to make trades. We're in trading to make money. We're not in trading to make trades. Now we make money by making trades, but only by making the very highest probability trades. So the reason I point this out is because a lot of traders feel like if they're a trader or they're sitting in front of the computer, they need to have a trade on all the time. You don't need to have a trade on all the time. A lot of times the best trade is not to make any trades. We only want to trade when the institutions are driving it and the setup is correct for us. Okay, so we as profitable traders, as retail traders, we need an edge. We need an edge over the other retail traders. And the edges that we have here in the compass room and on the alert service is I use what's called the right line compass system. And I'll show you that. It's a piece of software that tracks institutions so we can determine if institutions are in the trade or not. We also trade what's called relative strength and relative weakness. This should not be confused with RSI. Relative strength, relative weakness is compare your stock that you're interested in. What its 5 by 5 minute by 5 minute movement is relative to the S&P 500 or the Qs. And if the SPY is going sideways and down, and your stock is going up at the same time, it has relative strength. It's pretty simple, and vice versa. But these give you a big edge, because if the market reverses on you and you're in a trade that's got relative strength, it's not going to reverse as fast. Just because it had relative strength to start with, it may even keep going up. So those are two really important things. And by knowing if the institutions are in and trading relative strength and relative weakness, your win rate is going to get up into the 80s. We also trade with the market trend if there is a market trend. If we get a trending day in the market and it's a bullish day, we're going to basically mostly look for longs. And we try to buy near support and sell near resistance. In other words, we're not trying to chase stocks as they rip up in the morning or suffer from FOMO, fear of missing out. This is what happens to a lot of traders. They see a stock really moving quickly up or moving down. They jump in because they're afraid they're going to miss it, and they get in right at the top and it reverses, or right in the bottom and it reverses, and they get trapped in the trade. So this takes some patience. You need to wait for this. Okay, the compass system I'm going to just talk about briefly. This is an important system. This identifies the highest probability trade setups while allowing us to sidestep setups that are not going to be profitable generally. It does this by identifying when the institutions are driving the move and when they're not, and analyzes a lot of really complex data and displays an easily identifiable visual format. This is what really makes a big difference, because if without getting into a lot of detailed technical analysis, the compass system is going to allow you to determine if the stock is bullish or bearish, or if the institutions are in it is bullish and bearish, or if they're not. And that's going to guide you to which stocks to take and which ones not to take. Again, this visual element makes it possible for even new traders who aren't really familiar with a lot of technical analysis to find high probability trades. And I'll show you a lot of examples of those. Again, so this is how we get an edge over retail traders. We're only taking trades that are being driven by institutions. I keep repeating this. This is critical. Trading stocks that have relative strength or relative weakness versus the SPY or the Qs, and trading in the direction of the overall market. And if you can do this, when you take a trade and you have these elements in it, you're going to make money most of the time. I mean, this is a high probability. You know, I can't control when you get in and when you get out. I can kind of control when you get in, but I can't control when you get out. And you know, people have different tolerances for risk. They have, you know, if they start to lose money, they get panicky and get out of a trade. Sometimes I can't control that, but I can let you know when a trade is likely to be profitable. And this, how does this give us an edge? Again, trades are going to be supported by institutional buying and selling. It's going to be outperforming the SPY, and they're going to be moving in the direction of the overall market. Very big, very important information for trading. And I'm just going to spend a little time here on how we find high probability trades. This is really important information. This is going to help you find good trades. If you run your trades through what I call a setup funnel, obviously this is just, you know, this is actually not a real funnel, but this is the thought process I go through. When I'm looking at a trade, the first thing I look at is to make sure the daily chart and the 5-minute chart align. So if I'm going to go long a stock, I've got to have a bullish daily chart. If I'm going to go short a stock, I've got to have a bearish 5-minute chart, a daily chart. And then I want the 5-minute chart to align. So once I've determined that a stock is bullish and the daily chart looks good, then my job is to watch the 5-minute and find a good entry point when it also turns bullish. And that's how I get into the trade. Again, I want to trade with the trend, both the stock and the market. Obviously, if the market is bullish for the day, I'm going to be looking for stocks that are trending up. I'm not going to be looking for stocks that are trending down. And then the third thing, and this is critical, the compass indicators need to tell me that the institutions are in the trade as well. So daily chart looks bullish, 5-minute chart looks bullish. The compass indicators tell me the institutions are driving this. This gives me the information I need to determine whether that's a good trade or not. And then I want to trade relative strength and relative weakness. So if I have 6 or 8 trades that look really good, I'm going to take the one that has the most relative strength to the market, or relative weakness if I'm going short. And then I'm going to look to enter near support or resistance. If I'm far away from support or resistance or quite a ways away, I'll go ahead and set an alert on at a level so that I can be alerted when it comes to the level that I'm looking for. Okay, so that's the high probability trade setup funnel I use. So, and this is just basically just as verbiage of the same thing. But you notice I've got stock to be traded should have daily and 5-minute chart aligned, and the compass indicators must align in the direction of the trade. Those 2 things give me a huge amount of advantage over other retail traders. And again, we want to have patience. One of the other things is when you're trading on the 5-minute chart, make sure not to trade. Make sure you trade stocks that are price-wise, they're above the VWAP when you're going long and below the VWAP when you're going short. That's the volume weighted average price. It's on my chart. You can have it on, anybody can have it on their chart. Institutions follow this a lot. A lot of their buying and selling is right around the VWAP. All right, and again, have patience. And in the room, I'm just kind of go over what we trade. We trade straight calls and puts. We trade a debit spread using weekly options expiration. Time spreads over earnings. This is a non-directional earnings trade that we have, and I have videos on all of these setups. A weekly ATM strategy, which basically we just sell puts every week to capture premium on a bullish stock, and we do credit spreads. And the one thing I'm going to look at a little bit more today is what's called the SPY super system, and these are for very high probability trades to catch SPY or Qs or IWN moves. And I've quantified some of this in some of the trading I've done in July and August. I've done this for a long time, but this is really a really good system. And I know a lot of people like to trade the indexes, and they want to have fairly quick trades. These are all very fairly quick trades. Somewhere in the neighborhood of 5 to 25 minutes, something like that. And you only have one on at a time, so it's kind of nice and manageable. And a nice thing for this particular trade is if you're a member of my room, and you can't be there all day because I'm in the room all day long calling out trades, etc. But you can only come in for certain periods of time, short period of times. You're going to find some nice SPY super system setups all time during the day, almost any time. It could occur any time. So you could come in for 2 hours in the morning, 2 hours in the afternoon, and get some of these trades. And I'll go over what the setups are on those a little bit later here. And again, what the alert service I just want to highlight, it's designed for day trades and short-term swing trades. These are not for investments. These are for day trades, intraday trades, and short-term swings. And short-term swings I define as overnight to maybe as many as 2 or 3 weeks. But that would be what would be considered a short-term swing trade. Again, it's designed for traders who can't watch the market all day or don't want to watch the market all day. You're going to get real-time alerts on the highest probability trade setups. And the highest probability trade setups, obviously, we identify institutional involvement, market internals, is there more stocks going up than going down, and then we do some technical analysis on the individual stocks to find the best ones. And those are the alerts that you're going to get. And this is just an equity curve for about last year and a couple of months, based on if you put $2,000 into each trade. You can see that it goes from bottom left to upper right. This is what you want to see. How much you're going to make is obviously going to depend upon your risk tolerance, how much you invest in the trade, how much you've got in your account to trade with. But this is just kind of gives you a baseline, assuming $2,000 a trade. All right, so we're going to talk about options here. And a lot of people, most people know about options, but there's specific things you really need to understand about this. And I don't know, I know there's people that trade options and understand options, but I'm going to do some basic stuff, and then we'll get into a little bit more detail on them. All right, so first thing I just want to show is this is an option chain. If you're not familiar with an option chain, this is an option chain for Bristol-Myers. All option chains have the same information in them, no matter what platform you use. But the key things here is that you've got is on Bristol-Myers, this is the strike price. That is the strike price that the option is going to be. You can see this goes up in here 50-cent increments and $1 increments. This is a strike. Over here you have your bid price on the calls. The left side is always calls, the right side is always puts. Every platform, the calls are on the left, the puts are on the right. You've got a bid price and an ask price. So how much of what's the bid for this? You can see if we look at this time I put this, it was about $54 was the at the money on Bristol Myers. It was trading at $53.79. So people were bidding 61 cents a contract, and they were asking 66 cents a contract. So that's your spread. That's a 5-cent spread. That's pretty tight. Bristol Myers is not a fast-moving stock, so that's a pretty tight spread. So that's the bid-ask spread. Same, obviously, the same thing on the put side over here. And as you slide out here, slide up and down. As you go on calls, as you drop down in price, these become in the money, and as you go out of price, these are out of the money. So you can see the ones that are out of the money, since the stock hasn't got to that price yet, they're going to be cheaper, and the in the money ones are going to be more expensive because you've already got some what's called intrinsic value, which we'll go over. All right, so that's the information that's on there. Here is your expiration dates across the top. Obviously, Bristol Myers has expirations every week. Some stocks only have expirations every month. And your ETFs or your SPY, Qs, and IWM, they have expirations every day. They're what's called zero DTE, or 0 days to expiration. So the strike prices are going to be, and the expiration dates are going to be based on when there are expirations for that particular stock. Most of them are going to be monthly. A lot of them are going to be weekly, and only some are going to have daily. And for our purposes, only the SPY, the Qs, and the IWM is what I use daily for. All right, now the other thing in here is called delta. Delta is, we're going to discuss what it is, but this kind of tells you how much your option price is going to move based on a dollar move on the stock. So of course, as you're deeper in the money, this is going to be much higher. So in a $50 call on Bristol Myers, which is already trading at higher than that, is trading at almost $54. A $50 call has about $3.79 of intrinsic value. That has a delta of 96. That means for every dollar that Bristol Myers moves, this option is going to move 96 cents. As you move down, as you see at the 54, which is an at the money call, for every dollar that Bristol Myers is going to move, the option is going to move 52 cents. Okay, so that's the difference here on delta. All right, and it's obviously the same thing applies for the puts. Now this over here, I highlighted one other column, same exact information that we just talked about on here, but the information I got here, this is what's called OI and volume. OI is open interest, volume is obviously volume, how much is traded for the day. Now the difference here is open interest is how many options contracts were open at the beginning of the day, not counting today's trades. How many were open when the day started? So this was like 11,867 contracts were open on the $50 strike on Bristol Myers, expiring whatever expiration date I had here. And the number in blue here, these are the number of contracts that were processed today. So that's open interest and volume, and it gives you an idea of how active that option is. And when there's a lot of open interest like this, 11,000, 17,000, obviously that's called liquidity, and you're going to be able to get in and out of the trade really easily when you've got high open interest. All right, I got a couple of questions. Let me just check here. Do we get to replay the recording? Will be good. Yeah, you'll get a recording on this. Yeah, everybody who's registered will get a recording after this is over. All right, so that's an option chain. For anybody who's unfamiliar with it, this is what you'll be looking at when you wanted to trade an option. All right, so we're going to talk now a little bit about options. All right, so kind of what I'm going to cover is what options are. I know it's maybe not as simple as you think. What makes up option premiums? When you pay a premium for an options, it's made up of certain criteria for what you're paying. We're going to cover what's intrinsic versus extrinsic value. This is really important. All right, very important. Greeks, we're going to talk a little bit about the Greeks. This is one of them we talked about was delta, but we'll talk a little bit more about the theta, which is time decay, and some of the other ones here. Dan, what's the number above the delta on the option change? Let me go back and see here. Above the delta. This was 154, 162. You're talking about this right here. That was probably the last price that went off. I don't know on this particular. This was coming off, I think, a swim, I think, and I don't use this one, so I don't know what that is. Probably the last price that it went off at. Okay, so Greeks, we'll talk about these. I'm not going to get into every single Greek, but I want to go over the ones that are critical, and the ones that are critical is delta and theta, which is time decay. We'll talk about the strike price and the expiration date. This is really important as far as when you're trading options. It's really important to know what strike price to take versus the price that the stock is trading at, and what expiration date to take. Because all these things are going to impact the price of what you're paying for it, and the success level, the likely success rate. And we'll talk about volume and open interest. We just did that. And I'm going to go over what the primary option trades there are, and I'll go over the ones that we typically take. We're also going to cover what option strategies are bullish. In other words, if you like a stock long, what are your choices for trading options? What strategies are there? Because there's several. On bearish options, same thing. Neutral option strategies, there are option strategies that are considered neutral, which means you don't care whether the stock goes up or stock price goes up or down. And then we're going to talk about the trade setups in options, the best way to set up these trades. All right, and we're going to talk about what are options here. All right, so we have calls and puts, and what's called rights and obligations. Now, this isn't all that complicated, but it's important to understand this. And we're going to talk about this here in just a second. But obviously, with options, you can buy them or you can sell them. Right? You can obviously buy them or sell them. You can buy them. If you're going to buy, you're going to be long a call or long a put. Long a call is you're going long the stock. Long a put means you think the stock is going to go down. You can sell. When you sell a call or sell a put, you're collecting premium on it, because you're actually selling that option to somebody else and collecting money. There's a lot more risk in this if you don't put them in spreads, and I'll go over that in a minute. Buying a call, a long call, is bullish. Selling a call, a short call, is bearish, and I would recommend, suggest that you never ever do this unless it's in a spread. Don't ever sell a short call because you're going to get trapped, and I'll explain why. And buying puts is bearish, and selling puts is bullish. So that's the long and short of these things. All right. Now, what's rights and obligations? Let me just cover that for a minute. When you buy an option, when you buy a call, you buy a put. What you're saying is, if I buy a Microsoft call at $100, that gives me the right to buy Microsoft, the actual shares, at $100 a share. All right. So I have the right to buy Microsoft at $100 a share, but I don't have to buy it at $100 a share. And most of the time, we don't do any of this. All we're doing is buying the options and selling the options to make money. But just understand that there are rights and obligations that go along with buying puts and calls and selling them. Now, when you sell a call or sell a put, this puts you in a position, because you're selling that call to somebody else and you're selling that put to somebody else. This obligates you to take the stock, either long or short, if the stock becomes in the money and somebody exercises the long call or long put that they've got. So just be aware that you have to take. You're going to just get it if you're in an option. Let's say you sold a $110 call on Microsoft, thinking it wasn't going to get up there. You collect the premium, and Microsoft goes to $150. Right? You are obliged at that point in time to sell Microsoft at $110, but you're selling it into a market that the stock price is $150. That means you're going to lose $40 a share on all options that you do. So just be aware that when you sell something, you're obliged to take control of it, or take assignment of it. And when you buy something, you have the right to do it if you want to, but you don't have to. All right. So that's buying and selling, and this breaks it down. Buying your long, obviously, and selling you're short. So those are the what you can do with options, and this is what you're going to be obliged or have the ability to do. All right. Now, the option premium price that we looked at, what makes up the option premium price? Options can be at the money, which is, let's just take, for example, we talked about Microsoft. Let's say it's trading at 100. The $100 call or $100 put is going to be at the money. Going to have options in the money. Anything below, any strike below $100 is going to be in the money. $95, $90, those are in the money calls are for the calls. If it's under $100, if you're buying a put, okay, an in the money put obviously is going to be higher price on the option. So again, at the money is the strike price. In the money is if it's already reached that level, and out of the money would be if, for example, if you bought a call on Microsoft, let's say it's trading for 100, and you buy a call at $110. All right, so the stock is $10 away. It has to go up to 110 for that option to actually become profitable. Then that's an out of the money, and these are the least expensive. All right, and the more in the money are more expensive. But these very rarely make any money. These, in other words, you're paying for something, and I'll go over that in a second. Well, you're paying for something that doesn't have any what's called intrinsic value. All right, so this is what makes up the option price. So again, at the money, in the money, out of the money. When I'm buying calls or buying puts, they're always in the money. I'm always buying in the money calls or in the money puts. And so the option premium price is made up of a few things here. It's made up of the price based on the price itself. So again, let's go back to the $100 call on Microsoft. All right, let's say you buy a $100 call and the stock is trading at $100, and you pay $2.50 for it. All right, so the stock is rated at 100, so you don't really have any money in the stock except it's zero. Basically, it's trading exactly at zero as far as the stock price is concerned, because you bought the call at exactly what the stock is trading for, basically at the money. But it's also going to be made up of intrinsic value. We'll go over what this is in just a second. It's also made up of implied volatility. This is what the market makers add to the price of the option premium to cover themselves, because depending upon how much the stock moves up or down, how much volatility there is in it. Okay, and then there's time decay, and the time decay is a premium that gets added to the option premium. That's based on how much time there is between when you buy this and when that option expires. So if you buy an option that expires, let's say Monday, you buy an option that expires Friday, the time decay is going to be really fast. As the stock gets closer and closer to the expiration date, the time decay is going to go down, 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 and your premium is going to go down, down, down. If you go to a month on your options, the time decay is going to be very slow. It's not going to decay very, very quickly. And the reason for this is because when you buy an option with a really close expiration date, it doesn't have a lot of time to get to the price that you want. So the time decay is going to come off very, very quickly. So that's what goes into this. So when you see an option price, it's made up of the stock price. Let's say you buy a $95 call on Microsoft that's trading at 100. All right, so the stock price is 100 and you bought a $95 call. Well, you've got $5 of premium built into that option already because of the fact that it's in the money by $5. All right, in other words, you buy the option at 95 and the stock's at 100, and you can immediately sell it for 100 and make $5. So that's part of the price. Intrinsic value, which we just discussed, if you're buying a $95 call on a stock that's $100, you have $5 of intrinsic value. In other words, that option has got value into it just because the strike price is lower than the price of the stock. Then you've got the implied volatility, which the market makers jack in there to cover themselves as far as the stock moving up and down quite a bit. And then there's time decay. How much time is there on that option before it expires? So what you've got is, if you get into a $95 call on Microsoft when it's selling at 100, it's going to be worth at least $5, because so the stock prices gives you 5. Then you've got, and that $5 is the intrinsic value. Then they're going to add more premium for the implied volatility, and then they're going to add time decay for how long before that premium, before that option expires. So what you end up is with $5 for the $95 option, plus implied volatility that might be $1, $1.50, plus time decay, which could be anything from a buck up to, if you go out 2 or 3 months in times, could be $3 or $4. So the the $95 call on Microsoft when it's 100 is going to be obviously more than $5. It might be around $7.50, and it could be a lot more if you go out further in time. So that's what makes up the option premium price. And so it's important to understand that you're going to pay more for in the money options than you are for out of the money or at the money. But in the money options will always be more expensive, but they also have a much higher likelihood of being successful. All right, that's what makes up the option price. Just so you know where this price is coming from. If we go back here and we look at Bristol Myers and you're looking here at this price, you see 61 cents and 66 cents. This is made up of intrinsic value, it's made up of volatility, and it's made up of time decay. All right, so that's what goes into those premiums. Okay, so that's what makes up that. So we just talked about intrinsic value. Again, this is just another explanation of it. The intrinsic value of the option price is the in-the-money value. So a $50 option on a stock trading at 55 has an intrinsic value of $5. All right, the extrinsic value is everything else. So in other words, if you buy in this particular case, if you buy a $50 option, a stock trading at 55, and the premium on the option that you're buying is $6.50, then you've got $1.50 of extrinsic value. In other words, you're paying $1.50 extra than what the actual intrinsic value is, and that's what your risk is on the trade, and that's what's called intrinsic value, and that's what can be drained out of the premium if the stock doesn't move. Okay, so, and again, important, the volume of options traded at a strike price and expiration date, as well as open interest of a strike and expiration date, is important because that's going to tell you how much liquidity is in the stock and how easy it'll be to get in and out of the stock. All right, so that's what intrinsic and extrinsic value is. It's important to understand the terms. I mean, all you have to do is just, again, go in, look at the price of the stock, look at the strike that you're taking, and if you're in the money, that the intrinsic value is going to be the difference between the stock price and your strike. Okay, that's intrinsic. Now the Greeks, we're just going to cover 3 of them here. There were more, but delta, which we talked about. This is how much an option price moves in relation to a stock price when it moves $1. So a delta 50 means an option is going to move 50 cents for every dollar the stock moves. And now this is kind of important because, like, when I take an option, I'm going to always go for a delta of around 65 or 70. I want to be in the money, and I want that stock price to move 65, 70 cents for every dollar the stock moves up. That's kind of the sweet spot for taking an option trade that's going to give you the best likelihood of being profitable. Then you have theta, what's called theta, which is time decay. And this is a decrease in the value of the option price as expiration date approaches. So again, this is going to decrease a lot faster when the expiration date is this week than it does if it's 3 weeks from now. So the time decay is important. This is really important because there's certain strategies that are set up to basically harvest this time decay by selling premium, but we'll go into that in a bit. Gamma, this is the rate of change in delta. So again, if the delta here is 50 at the money, if the stock moves into the money, the delta is actually going to go up. It's going to go from 50 to like 60 as the stock price moves up because it's deeper in the money. And what gamma does, it tells you what the rate of change in delta is. How much is my delta going to change if the stock price moves up? So if you've got a high gamma, it means the option price can change dramatically with only a small change in stock price. And to kind of go into a little detail on that, if you ever bought a stock that was really ripping up, something that had a lot of momentum, and you bought options on it, and the stock was going up, you know, let's say it shoots from $8 to $10 in 5 minutes, the gamma is going to be huge, and your delta is going to go huge. It's going to go from 50 it actually could go over 100 as the stock moves up really, really quickly. But as soon as the stock starts to level off, the gamma is going to come down fast, and the option price will start to actually go down even as the stock moves sideways. So that's important to understand gamma, because when you're trying to buy an option and the stock's moving really fast, be aware of the fact that they're going to jack up the price of those option premiums because the gamma is going to be high to try to take advantage of people trying to get into that trade cheap, and you can't do it. So just be aware of that. You know, basically the example I just said is if a stock goes from 8 to 10 and the delta goes from 50 to 80 or 90, and then the stock moves sideways for a while, not only will the delta come down, the option premium will start to come down as well because the gamma is going to come down. All right, so that's something to be aware of on stocks that really move up quickly. Okay, so the primary option strategies that there are, and I don't use all of these, but I just want to go over them. You can be long calls or puts. In other words, buy a call or buy a put. That's call being long a call or long a put. We can do put credit spreads or call credit spreads. This is a way to collect premium. We can do put debit spreads or call debit spreads. And again, there's a lot of criteria that go into these things, but these are basically the strategies that I use. I do this, I do these, I do put credit spreads, I do put and call debit spreads as well. I also do calendar spreads, what's called time spreads. These are non-directional trades. Condors I don't do, but that is also a non-directional trade. There are things called butterflies, and then there's also strangles and straddles. These are the main option strategies that there are, and some I use, some I don't use. I don't use any condors. I do use everything else to some extent. Okay, so this is a kind of an interesting sheet. These are bullish, bearish, and neutral option strategies. These are the option strategies that you're going to follow if you're bullish, bearish, or neutral on a stock price move. In other words, if I'm bullish on a stock, the stock I think is going to keep going up, then these are the particular strategies I can use. I can go long calls, or I can go short puts. I can sell the puts. I can also do put credit spreads, and I can do call debit spreads. All of these particular strategies are bullish. The bearish are going to be just the opposite. I can be short calls. I can be long puts. All right, sell the calls, buy the puts. I can have call credit spreads or put debit spreads. These are bearish strategies. Now again, I would never sell calls what's called naked without being covered by the stock or by a spread, being in a spread. But it is a strategy. But I would say don't ever do it. It's the most risky strategy. When you start selling things like naked calls, you have an unlimited liability, unlimited risk. And all of the trades that I take in the room and I put out on the alert service are what's called defined risk. You can only lose whatever you put into the trade. You can't lose any more. When you do a short call, you can lose a lot more. All right, and the neutral strategies are condors, which I don't use, straddles, strangles, and time spreads, which I do use. Time spreads I use over earnings. What these say is we don't really care which way the stock moves, up or down. But in straddles or strangle cases, we just want it to move a lot one way or another. Condors, you want it to stay in a fairly tight range. In time spreads, basically you don't care which way it moves. So that these are neutral option strategies. These are the bullish ones. These are the bearish ones. Again, don't ever do short calls. And short puts I would only recommend if you actually want to own the stock at a lower price. So those are those strategies for options. And this is a pretty good sheet to have around, so you know what to do if you're bullish on the stock. You know, okay, this is, if I want to do options, here's something I can do. Obviously, you can obviously buy the stock, but for option strategies, these are the ones you would use. Bearish, you would use these. If you're neutral, you don't care which way it goes, then you can just go ahead and take and this would be a case like if you had a stock that really shot up, it's up 50 or 60% today, it's shooting up. You don't really care if it's going to go up or go down from there. You just want it to move a lot. You can use what's called a straddle or a strangle. Okay, so these are the setups for doing options. All right, so put credit spread. Put credit spread, and this is a put credit spread is a bullish strategy. And what you're doing is you're selling a put on a stock and buying a put at a lower strike price, and you get a credit when you do that. It goes right into your account immediately. Same thing as a call credit spread, but a put credit spread, this is a bullish strategy. A call credit spread is a bearish strategy, and a put debit spread is a bearish strategy. You're buying a put and then selling a put at a lower strike price for a debit. You have to pay a debit for this, which is why they call the debit spread. But you're expecting this stock to fall, and you're getting in at a cheaper price when you do a spread. And a call debit spread, same thing. You're expecting the price to go up. This is bullish. You buy a call and sell a call at a higher strike price. When you sell a call at a higher strike price or sell a put at a lower strike price, in this case, what you're doing is you're reducing the amount of premium that you're paying for the trade. You can get in cheaper than buying a straight call or a straight put, but you are capping your profitability on it because of the fact that you've got a spread on. All right, so those are the credit spreads and the debit spreads. A calendar spread is a case where we sell a put or a call at or near the expiration date. In other words, if you've got earnings coming up on Thursday, you can sell a call or a put for that Friday's expiration, and then you buy a call or put for expiration the next week, for example. So this has basically the same strike price, but different expiration dates on a calendar spread. And this is what I use for earnings. It's called a time spread. There's a time spread right there. A specific calendar spread using current week's expiration and next week's expiration. So typically what I do is I'll sell a call for this week at roughly at the money, and then I'll buy a call for next week roughly at the money. And that's how we do a time spread over earnings. What we're doing is we're capturing the volatility change when the options come out. And then you've got a strangle. You're buying a call and buying a put one strike or more away from at the money using the same expiration. So if I was going to do a strangle and the stock was trading at like $100, I would buy like a $101 call and a $99 put. So I've got one strike above at the money and one strike below. It's called a strangle. A straddle is buying a call and buying a put for the same strike and the same expiration date. This is basically if the stock's trading at 100, I'd buy 100 call and 100 put. I don't care which way it moves. I just want it to move fast enough to justify the cost of that particular straddle. All right, so that's the option strategy setups that there are. Obviously, I didn't put straight calls and puts in here. You're just buying the call, you're buying the put. It's not really, there really isn't any particular setup you need. You're either bullish or you're bearish. All right, now choosing the best option. This is kind of important. So obviously, when you take a look at a stock, if you're bullish, the strike price are important, the expiration date is important, and the delta is important. So what I'm looking for is when I see a stock that's trading at 100, I'm typically going to buy a call at a lower strike price. I'm going to buy a $95, $96, $97 strike. It's going to be an in the money strike price, and that's going to give me a delta of around 65 or 70. That's what I look for. The expiration date is kind of dependent upon how long you want to be in the trade, but I would definitely recommend going out further than what you think you're going to be in the trade. Like if I'm in a trade that I think it's going to expire this week, I'm going to go out at least to next week, probably 3 weeks further out in time for expiration date, and that's going to reduce my time decay on the trade. I can get in today and out today and have an expiration date of 3 weeks from now and still make good money on it, but protect myself in case the stock doesn't go where I expect it to today and I need more time on it. So you don't want to limit your time too much on when you're going into a trade. So that's the strike price again, in the money. If you're doing puts, you want to be in the money on the puts. So you're going to pay more for them. And again, expiration date says the same. Delta is the same. You want this 65 to 70 delta on the puts or the calls. If you're looking at option chains, you're going to be able to see that, right? So those are the strategies that I use. that's the information on strikes. It's important to understand these things before you get into options. If you haven't traded them before, I would recommend doing it in a paper trade as opposed to doing it live with live money. All right, see if we have any questions here. Okay, I covered that one. Okay, so that's the information on options. Again, you'll get a replay on this. Hopefully, if it's confusing to you, it's very difficult to get into options, and if you've not looked at them before, it takes a little bit of time to internalize how these things work. But what I've done is cover that, and this is really important to know right here, because if you're looking at a stock and you like it and it's bullish, then now you know if you want to trade options, what can I do? What are my options to actually make this trade? I do this all the time when I'm looking to take a trade. I have to make a decision based on technicals as to what's my best solution here. If it's bullish and I want to buy straight long calls, how much is it costing me? Would I be better off doing a debit spread on it, or would I be better off doing a credit spread and just collect premium for the next 3 weeks? So all that comes into play when you're trying to decide what to do. All right, so those are the options. That's the information I've got on options here. I hope you found it helpful. What's my expiration date and what expiration period do you use? Yeah, my success rate is on overall in the room. Now this isn't for individual strategies. This is for my trading all the options. It's 85 to 90% is my win rate right now. Sometimes it'll slide down to about 82, but 85 to 90, generally about 87% is my win rate. Expiration period, typically, as I said, it depends on how long I'm going to be in these. You have to take into consideration when earnings occur and whether you want to be out past earnings or not, but you've got to sell it before earnings comes up. But usually I'm out on the expiration dates 3 to 6 weeks. Sometimes I'll only go out 2 weeks, but generally 3 to 6 weeks, boys, on the expiration dates. All right, so that kind of covers the option information. I'm going to just kind of run through. I want to kind of run through the trades that we've taken recently, and I just kind of want to point out the percentage gains. I want everybody to be aware of what we typically make on a trade. People think, if you can make 3, 4, 5, 600% all the time on trades, you can't. You just can't do that. You can do it here and there, but you're not going to be consistently profitable. And what the whole idea of my Room and Me alert service and is to help traders become consistently profitable month after month after month, not being up 2,000 this month, down 6,000 next month, up 4,000 the next month. That's not. You can't trade for a living doing that, and it's really not consistent. It's going to be way too emotional. But anyway, these are our January trades. Again, we had 20 wins and 2 losses. This 90% win rate. This typically that's pretty high. Generally, it's going to be a little bit lower than that. But we do have losers. We had 100% loss here in Gilead. You can see we had credit spread, debit spread, time spread. But you typically see these things are going to run anywhere from 10, 15% up to 40, 50%, sometimes higher than that. 65% Mara here. But that's what you're looking at. And some of these we were only in for a couple of hours. Some of them were in for 2 or 3 days. Some were in for a week. It just depends. What delta do I use when I trade credit spreads? Boys, I actually don't use the delta when I trade credit spreads. I know a lot of people do. What I look at when I'm looking at a credit spread setup, and just to get into a little detail on a credit spread. All right, a credit spread is a bullish strategy, so you're trying to collect premium. What I do is you sell a put and then you buy a put at a lower strike price. What I do is the put that I sell, my short put, the one that I sell, I want that to be below at least two strong support levels. So if I've got a 50-day moving average and a 100-day moving average, fairly close on the stock, I'm going to sell a put below those 2 moving averages. So I've got 2 levels of support above the short strike price, and then I'll buy a long put below that, and I want to be able to get a premium of at least 25% of what I'm putting into the trade. So if I've got a $2.50 spread, then I want to be able to collect at least 50 cents. So on a $2.50 wide spread. because if I'm getting 50 cents off of $2.50, right? My total risk is $2, and I've got 50 cents out of $2. That's 25%. That's how I do my credit spreads. And I've got a video. If you remember the room of the alert service, you have access to the videos. I have videos on every single one of the strategies that we follow, and credit spreads is one of the ones we do. So that's how I do that. I do not structure them based on the delta. I structure them based on the technical setup of the stock, so that I have a very high likelihood of the stock staying above my short put. And if I've got enough premium, then I'm happy. Okay, so again, there was January, pretty nice month, 20 wins, 2 losses. This is February, 24 wins and 2 losses in the room, 92% win rate. This was a big month. We had 11,000. This is based on 2,000 invested in each trade. We took a little over 11,000. For the alerts, we had 20 wins and 2 losses, and that is 69.30. You don't get as many. I can't do as many alerted trades as I do trades in the room, because trades in the room I call out, and if they're only going to last a half an hour or something, I can't alert them. It's not fair to the alert service folks. So anything that's going to be at least a few hours and or overnight or more, that I can alert on. But stuff that's very quick, that includes the SPY super system, which I'm going to talk about in a minute. So yeah, February we had 24 wins and 2 losses, 11,000 here, 11,700 here, and 69.30 on the alert service. And I just kind of recap the 2023. This was last year, just to give everybody. Let's see, do I trade the alert you give to others? Every trade that I either call out in the room, if I call out in the room, in the room I actually post the trades on a sheet that's in the room, and we also have a Discord room where the trades are posted, and then the alert service as well. I take every single trade that I call out or send out an alert. I have them all. I always take them. I take them on my own account with real money, and so I know exactly where all these things are at. So I don't ever give out a trade that I'm not taking myself. Now people ask me in the room if I like a particular setup, then I'll definitely give my opinion on it, but doesn't mean I'm necessarily going to take it. But I'll say that's a good setup, it's a good trade. Yeah, it's fine. It doesn't mean I'm going to take it, because we talk about stocks all day long. But when I take a trade, I'll say, okay, I'm getting into this trade. I'm getting into it here, and this is the strike price. It's the expiration date. Here's how much I'm paying for it, and everybody in the room knows it, and everybody in the alert service knows it if it's an alerted trade. So yeah, I trade them. I trade them all. All right. So in 2023, if you invested 2,000 in each trade taken in the options room, it produced a profit of a little over $60,000. So if this is just informational, if you had a $50,000 account, each trade with 2,000 would have been 4% of your account. By the end of the year, the account would have been up to 110,000. So at the end of the year, every $2,000 trade would account for less than 2% of the final account's balance. The whole point here is that the account goes up. Obviously, not everybody's doing this. You don't trade the same amount on every stock, on every trade. I don't. You vary it based on the expectations of how the market's doing, et cetera. But this just gives us a baseline. So obviously, if you invested 1,000, you'd have half of that. If you had 4,000, you'd have twice of that. So it just depends on your risk tolerance and your account balance. All right, and this is 2024. This was the trading results for the first quarter. In the room itself, we had 65 wins and 11 losses, 86% win rate, about 18.7 roughly. In the alert service, 41 wins, 6 losses, 87% win rate, 12.2. So these are kind of shows you that how many trades we take in the room versus how many trades we take in the alert service. And the percentage win rates are very, very similar. Sometimes the alert service will do better. Second quarter, 65 wins, 14 losses, a little lower, 83% win rate. Typically, most people would kill to get a win rate of 80%. It's not easy to get a win rate of 80%. The alert service, 35 wins, 6 losses, 85% win rate, 11.7 here on second quarter. All right, so that's the results that we've had in the room and on the alert service for the first couple of quarters. I did want to just kind of cover May, June, and July trades here, just so you can see specifically recently what we've been able to do. I highlighted time spreads here. These are the calendar spreads we do over earnings. I have a video on how that's done. We're in earnings season right now. But again, we have losses. We had 100% loss there in BKE. It spiked way more than they expected it to on earnings. But all in all, we had a pretty nice month in May. You can see the percentages: 48, 38, 38, 25. 15 alerted trades, 15 wins, 2 losses on alerted trades, 88% win rate, 49.79. Options room May trades, we had 29 wins, 7 losses, 81% win rate, and 2,000 invested, netted 57.36. So the room actually did pretty good. It had a higher win. I mean, the alerted trades actually did pretty good relative to the actual room. This was June. Same kind of breakout here. And we had a one-time spread here because we're close to the end of earnings season. We had some losses. We do have losses. Everybody takes losses. We do as well. June trades, 25 wins, 4 losses, 86% win rate, 75.90. The alerted trades, 14 wins, 1 loss. This was really good on the alerted trades. It went up 92% win rate, 8,300. So we need more on the alert service than we did in the room. And in July, kind of a weak month in July here. We had 22 wins, 4 losses, 85% win rate. The alerted trades, 12 wins, 4 losses, 75% win rate. This was really low for us. We still made $3,300, but that's I'm not happy with that. I'm not happy with that. But listen, that's part of trading. But all in all, you made money, so that's the most important thing. So that's kind of just give you the kind of the results. Let me just go over quickly what the alerts service is going to give you. You're going to get on every alerted trade, you're going to get the stock symbol, you're going to get the strike price, you're going to get the expiration date, and how much to pay for the option, which could be a range. It could be a range. One of the things I always note is that this could be $1 to $1.05. When you I usually send an alert out when I enter the trade, and then I'll send another alert out when I decide what price we want to try to get out at. All right, so that's what the alert service is going to do. It's going to give you 2 alerts, one to get in, one to get out most of the time. And when you get an alert for the exit, it's better to mark it as good to canceled, so that it's always active when the market opens the next day in case you're not there. All right, so I want to spend some time, and I know this is getting pretty long, but how do we achieve these kind of results? I want you to know how the Compass system works and what it does for us. Again, we're able to identify when institutions are driving a trade and when the market internals are heavily bullish, and so we only take trades when these line up. All right, and we do this by looking at what's called triple screen assessment. The Compass system does that by looking at 3 different things. It looks at momentum, trend, and money flow across 3 different time frames. All right, so it's looking at momentum across 3 time frames, trend across 3 time frames, money flow across 3 time frames. When these are all lined up across 3 time frames, all going in the same direction, then the likelihood that an institution is driving the trade is extremely high, extremely high. So that's how the Compass system does that. I'm not going to get into a huge amount of detail on the Compass system because it would take much too long. But this basically is what the Compass system looks like on Thinkorswim. This is it. This is a picture of it off of my trading platform. This is Thinkorswim. I do not trade on Thinkorswim. I use the Compass system on Thinkorswim, but I trade through Tradia using TradeHawk. So if you get the Compass system and you identify when the institutions are in there, doesn't mean you have to trade on Thinkorswim. You can trade on Fidelity or Scott or wherever you want to trade on, Tastyworks, whatever. But this is where you get the information. This indicator right here is long-term trend. This is multi-time frame momentum. This is current time frame momentum, and this is derivation of money flow. When they're all green or blue, it's bullish. When they're red or yellow, it's bearish. But that just kind of gives you an indication of what the Compass system looks like right here. And I'm not going to get into all the details of the Compass system. There's a lot of indicators, a lot of ways to use it. But I do want to show you one thing here for anybody who's interested. I have a lot of people, so I haven't really done a lot with this before to show it because these are quick trades. This is what's called the SPY super system. These are intraday trading on the SPYs, Qs, and IWM. These trades last, typically from maybe 5 or 8 minutes to maybe 20 minutes. And it's trading the SPY the Qs and the IWM off of the compass system when I know the institutions are in those trades, either bullish or bearish, and I have the specific criteria setups I need. And so it doesn't happen all the time, but I've been kind of tracking them lately because I put together a video on the SPY super system and how to use it. And I have a lot of folks in the room who actually can't be there all day, but they want to make some trades. And a lot of times, I may not call out a trade that's going to be overnight for the whole morning, and they want to trade. So this intraday trading on the SPYs and the Qs is really a great way to do it. And I have a video on it. If you have the compass system, you can see this. If you're in the room, I let you know when I see a setup like that. But I just started tracking these results. So this was the July super system. I had 16 wins and 0 losses, 25.96. Not a lot of money because these are fairly quick trades. A lot of times they're fairly quick trades, and they have a very low risk because because of the criteria that I use to get into the trade, if it goes below my stop, I'm out pretty quickly. So I don't have any very big losses. In this case, I haven't had any. August, I started really ramping this thing up for this month because so many people in the room were interested in it. So I started tracking in much more detail. So for the first 2 trading days, I had 9 super system trades on the first 2 days of the month, Thursday and Friday. So I had 9-0. I had 9 trades, no losses. 2,000 invested, produced 15.98. Doesn't seem like a lot, but the thing is, these are fairly quick trades, and still, I mean, $1,500 in 2 days is pretty good off of these. So, and again, with the SPY super system, when you're trading this, and you have to be in the room to get this because I can't alert on these. But when the SPY super system, you're only going to have 1 trade on at a time. You're not going to be managing a bunch of trades, and they will be very short duration trades. So you can be in and out in 5, 10, 15, 20 minutes. The setup on these things is, as you can see, is extremely. It's been extremely win rates really high. I mean, you're gonna have some losses from time to time, but this is when I just started tracking it. But in case you're interested in trading short-term indexes, this is what I use, and you would get that in the room. And I have a video on it as well. All right, so this just kind of shows this. This is the SPY super system right here. This is one of the trades I took recently. This is the compass system. What I look for is the color down here, the current time frame momentum. This is what I focus on. When it goes from red bearish to blue bullish, then I'm looking for a chance to take a trade coming off a support or resistance level. You see how we get this this red to blue? You see I get this. This is a pop out of the box signal right here in the 5-minute chart. This pink line is the VWAP. The stock gets above the VWAP. This is where I take the trade right here. And this is the trade I took. I write it up here and I get out. So it's at about 20 minutes or so in now. That's what the SPY super system looks like. The compass system is telling me that the institutions have gone from selling or not doing anything to buying. I'm looking at a support and resistance level. If I get in above this VWAP right here as it breaks through, that becomes my stop. So you can see how close I am to the stop on the trade. All right, so these are just some quick trades I wanted to show you on the SPY super system. Again, down here we've got the current time frame momentum was bullish already, but I'm waiting for a stock to pull back to a support level. This little green line is the 15 EMA. It pops off of the 15 EMA. That's my entry right there. And everything stays green. I did go through yellow, but so I had to watch it briefly, but it went sideways and then it moved up and then I get out. Another quick trade. So these are what they look like. They're bullish, they're bearish. This was a bullish one here. Here we go from red to blue. Institutions selling, institutions buying. I'm breaking above the VWAP. I've got a pop out of the box or a breakout of compression signal. I buy it here. I write it up to here, and I get out right here on this red candle. It doesn't look like much, but a lot of these things can produce $40, $50, $60 per contract, in a short period of time. Again, this is for people who are interested in doing that. There's another one here. This is just a short setup. So I'm not going to spend a lot of time on this, but this was a short setup right here. See that it goes bullish, green to yellow, bearish, breaking below the 15. I pop out of the box symbol. I buy it right here, and then it stays above the 15. Notice I don't get out because it hasn't gone above the 15 and it breaks down. All right, so those are I have a bunch of these, but I'm not going to go through all of them. So I just wanted to show you what the SPY super system looks like in case you're interested in it. You get it, you have to be in the room to get it, but it's, you know, I keep this compass system up on my chart all day. And again, I'm in there every day from market open to market close. So if there's a bunch of them, you'll get at least to see them. And these are some of the regular trades we've taken recently. These will be alerted trades and trades that we take in the room. We did a Lulu, this was a put debit spread, but we took Lulu overnight. We took a 56% profit, get in at $1.92 out at $3. So that worked out pretty nicely. This is where we get in right here. This is the daily chart. You notice the stock coming down and breaking down right here. And notice how everything went red and yellow. That was a nice short workday, nice long. Everything went to, this was choppy, but it was blue here. This was a current time frame momentum when the daily chart was bullish. We liked the break here as the stock broke out. This is a dynamic compression zone. Bought it here and made 30% in 5 days. We were in that whole week. GCT, this was a 2-day trade right here. We get in here, 26% in a 2-day trade. Get in here, get out here. And this is just kind of showing what the compass system looks like. Again, I'm not going to delve into a lot of detail on it, but you can see that this is telling me that the institutions are bullet buying. And it's easy to see. Green went from yellow to blue. Then institutions are in there. This is where I'm going to buy. As the stock breaks out of this dynamic compression zone that the compass system puts in, I buy it right here and up it goes. All right. BKTX, same thing. McDonald's overnight trade. This was a daily chart. We get in for 8:30, out for 11:30 the next morning. $3 per contract, 37% gain. And again, everything's green. You can see the institutions are buying here. It's green across the board. Price moving sideways. We wait for a breakout of compression before we take it. Amazon, we took this. This is a 5-minute chart, 32% in 45 minutes. Everything's green. Pop out of the box symbol. By the calls, up it goes, and out. We're in 45 minutes. We're out for a nice 32% gain. Let's see. This is ENPH. There's a question. How many options can you be in at one time? You mean, Stephen? You're talking about how many different trades can I be in at one time? If that's what you mean, then yeah. I typically don't have more than 4 or 5 what would be considered swing trades open at a time. I don't want to try to manage more than that. So most of the time it's only going to be 2 or 3. I think we just have 1 on right now, but it can go up as high as 5. This is not counting the SPY super system trades, but the trades that are alerted and the trades we take in the room, which aren't necessarily really quick trades. Yeah, probably around 5, I would say. So if you're doing 2,000 in a trade, you would have to have about 10,000 to allocate to have that many trades open. Obviously you don't have to take them all. And this was ENPH. You see this 5-minute chart. VWAP here. You see this breakdown right here. This is where we get in. You see how it's sliding sideways, compressing. This is telling me this compass system puts out this pop out of the box symbol. I buy it here. I make 20% in an hour. As the stock breaks down, just follows it down. These are really pretty no sweat type trades here. Verizon, this was another 5-minute trade, a 5-minute chart, 50% in an hour. We get in this trade at $45 a contract, 45 cents, as it broke below the VWAP with a pop out of the box symbol. We were in an hour. We get in for $450, $45. So if you bought 10 of them, $450. We get out an hour later for $670. That's a pretty nice move in Verizon. Verizon is fairly inexpensive options, and we were out to the next week on those too. So they're actually in the money. And again, this is SPY super system setup that we've already talked about. Again, breaking below to see the 15 EMA right here, the little red line. I'm looking for a support or resistance level I can come off of, either the VWAP or the 15 EMA. Here's the breakdown right there, which is where I buy it. And then I write it down. And as soon as I start to see momentum waning, I'm out. See how this thing is red across the board here? Everything's short. I don't want to just take a short until I get a good break off of a compression level, which is what I did right there. Okay. And Tesla, again, we use Tesla. We used an overnight trade here. We had a pop out of the box symbol on the 5-minute chart the previous day. Everything was yellow or red. We took puts. The stock dropped from 120 to 112. I mean, that's sometimes you get a lucky break when you get a gap down like that. But again, a big trade for us. All right, so that kind of covers it. I know I've taken quite a bit of time here, but again, here's the strategy we use in the room in the alert service. Straight calls and puts, debit spreads, using weekly expiration, time spreads over earnings. And you don't have to take all of these, but they're all explained, and I let you know exactly what the trade is when I take it. Credit spreads, and then the SPY super system, which we talked about. Again, this is only in the room. I can't alert on these; they're much too quick. But some people like to trade, I mean, you can use the same strategy on ES if you're trading futures, ES, NQ, RTY, whatever futures you want to trade on. But if you want to trade futures, but I do it straight calls, puts on the ETFs, the SPYs, the Qs, and the IWM, Russell 2000. All right. So I just want to let you know what kind of a special we've got on the alert service and the room. Basically, the Compass alert service, quarterly $4.98. This, and you see what we make in the alert service, so that's pretty inexpensive. But $4.98 for a quarter, annually $14.96, and you get a lifetime if you want for $24.96. Get you into the alert service for forever. It comes with 1 month of the trading room for free. You get into the trading room so you can try that out. It also has a Discord chat, and obviously you get the text alerts. But we have a Discord room where we have 2 other professional traders in there posting charts, answering questions. I have all these videos on all of these strategies we talked about, the Compass system, the indicators, how to use them. I have them on all of the strategies we use. Obviously, the time spreads over earnings, and also the SPY super system. But there's about 25 or 27 of our videos out there right now. So this is what you can get the alert service for, $4.98 for a quarter. Pretty inexpensive, actually, and $14.96 even less expensive. And then lifetime if you don't want to be messing around with signing up every year for $24.96. Okay, and now this is the trading room itself. If you're interested in the room, okay, the options live trading room, it's $11.98 for a full year, which is really good. You saw what we made last year, 60,000. That's a pretty good investment. 148 on the monthly. Whoops, what happened here? There we go. 148 on the monthly. And again, you can use coupon save 50. And there will be links, by the way, in the chat box here. There will be links to basically sign up for the whatever particular sale you want to take. There should be links in the chat box. If you have any questions, you can call Rory at 786-732-4656, and he can take care of your questions and make sure you get what you want. All right, so that's the trading room itself. Again, $11.98 for a full year, $148 for a month. If you want to try it for a month, it's not a long time, but at least it gives you a little bit of a flavor. And then if you want to buy the Compass option system, this is a system that goes on goes on the Thinkorswim platform, the one that I just showed you. You can buy that for $12.49 for a year, or quarterly for $5.98, and that's going to include my entire workspace. So it's going to look exactly like my Compass system does on my workspace, and you'll get a whole bunch of scanners. We've got a bunch of scanners that comes with the platform as well. And you don't have to worry about it technically. The folks at Rightline, the technicians down there, specifically Sergio, who will go ahead and install that right on your machine, so you don't have to do you don't have to think about the technicals of that, and you just plop it right on your machine and you're done. So those are the three options you've got here to invest. You can either get the options alert service, you can get the room, or you can get the Compass system, which by the way comes with also a 1 month live in the trading room, or in the Discord and chat, etc. So all of those, you all get the videos on any of these. You get all of that. So those are the particular sales that we have on. These are really, really good prices, obviously, as you've seen what kind of results we've got. So again, I've taken up a lot of time. I appreciate the the attendance. I appreciate all the questions. Again, if you go into the chat box, you'll see the links to the alert service, the trading room, or the Compass trading system that we have, or the one that goes right on your Thinkorswim platform. So again, I certainly appreciate everybody coming here. I hope the alert, the description I did on options, which is it's fairly complicated. I tried to kind of pare it down a little bit so we just get the highlights, but there's certain things you really need to know. And again, you'll get a video of this, a copy of this video, and you can look at those again. But I hope to see some folks in the room or in the alert service. I think that it's for anybody who wants to be consistently profitable. You're going to get some good trades, but you're going to get even more so. You're going to get some really good education on trading, technical analysis, how to use options strategies, why we use certain option strategies. We talk about that all day long in the room, and we talk about a lot of particular setups and why certain ones are good and why certain ones aren't. All right, so then I appreciate so much everybody being here. I hope everybody has a great weekend, and I look forward to seeing some folks in the room and or on the alert service. So have a great weekend, everybody. We'll see you folks first of the week.